Hello, we are Matia, Arsène, Paula, and Yvette, and we are going to explain the project of Berria Chapela, a new business opportunity. I'll start by going through the agenda. The plan for today is to first give a little bit of background on the investment opportunity, then to give details on the profitability and resources for the project, as well as on the cash flow and working capital needed, and finally, talking about the value creation and giving further recommendations. The business opportunity consists of opening a beachfront bar franchise created by a new Basque chef in San Sebastián Beach in Barcelona. Our target clients are basically people that like to go to bars with family and friends, especially tourists aiming to have a fun time. The initial investment for this project is of 300,000 euros that will be paid in two installments, one in 2025 of 100,000 euros and the other one in 2026 of 200,000 euros, which will be depreciated over 8 years. Note that the sales are expected to grow at a compound annual growth rate of 2%. Barcelona offers a prime opportunity for investment in its famous tapas and beverage market. Tapas consumers spend more or less between 7 to 25 euros per head in Barcelona. This range allows for flexibility, attracting both budget-conscious locals and tourists that seek for a premium experience. In 2023, Barcelona saw over 14.7 million tourists, many of whom prioritized dining out as part of their experience in the city. This provides a continuous customer stream, especially in tapas bars, making tourism a key driver for potential revenue. Also, Barcelona's tapas and beverage market was valued at 12.7 billion euros in 2023, highlighting the strong demand and growth potential of the project. This large market size represents a stable and lucrative opportunity for investors. This project, as I said, represents a strong investment opportunity because it has many strengths. With a prime coast location at San Sebastián Beach near Hotel Vela in Barcelona, it requires a minimal working capital due to upfront cash payments from customers and favorable supplier agreements, which enhance cash flows. Furthermore, the project has a strong growth potential and expansion opportunity, with sales projected to increase by 2% annually. Additionally, the cost structure is optimized, with decreasing cost of goods sold and also an 8-year depreciation plan that aims at sustainable profitability. Altogether, these factors make this project a very attractive investment.
For the profitability and the resources needed for the project, we have had a look to the profit and loss. In the first table, the one we can see above representing sales, we can see as these sales increase at a compound annual growth rate of 2%. And also noting that the first year, the cost of goods sold was 32% of sales, decreasing to a 30% by the end of year 2. Then, in the second table, which is the one in the middle representing the gross margin, we can see a steady increase around 2 to 5% per year between year 1 and year 4. And also, in addition, personal expenses are estimated to account for the 25% of sales, representing the expected staffing requirements. And lastly, the third table, which is the one we can see above, representing the earning before interest, taxes, depreciation, and amortization, also shows an increasing trend of 2 or 3% increase per year, knowing that the tax rate is fixed and is set at 30%. Then, in terms of investment and capex, as already mentioned in the beginning of the presentation, we have the initial investment that Yvette has explained you, but the project also requires an ongoing annual investments in non-current assets, starting from year 1 with 48,000 euros annually and beginning year 4 with this amount increased to 55,000 euros per year. Some additional notes we should keep in mind is that this initial investment is distributed over 2 years, making it more manageable. And then the capital expenditure is specifically designed for acquiring non-current assets. We should also keep in mind that these assets will be depreciated evenly over 8 years period, meaning that the cost of these specific assets will be spread across these 8 years. In this slide, we can see that the earnings before interest and taxes for the project are also key for evaluating the post-tax operating profitability. That's why we've thought that it's important in our presentation. So we can see that the value in year zero starts at 130,750 euros, and then it reaches to its peak in year one, increasing slightly to 120,708 euros. Then in the subsequent years, in year 2, year 3, and year 4, we can see that they are all remaining above 113,000 euros each year, reflecting steady earnings. This consistency reflects strong financial health and also suggests effective cost management as well as operational stability. For the strong financial foundation, we can see that it has a robust capacity to maintain post-tax profitability, and it also reflects a stable foundation for future growth.
Let's now review the key financial ratios that showcase the project's profitability, efficiency, leverage, and cash flow over the 4 years. We wanted to highlight that the operating margin remains strong, consistently above 33%, peaking at 35.3% in year 2, which shows a good cost control. We also see that the net profit margin is stable, ending slightly lower at 18.5% in year 4. Return on assets starts at 35.7% in year 1, and then it stabilizes at around 36.7%, which highlights an efficient asset use to generate earnings and emphasizing the project's strong financial foundation. It's also important to mention that asset turnover it also improves gradually across the years, and inventory turnover shows enhanced management, with a major improvement in year 3, reflecting more efficient sales cycle. The debt to equity ratio shifts from positive to negative, which indicates reduced reliance on debt over time. Free cash flow to sales ratio starts negative but then turns positive in year 1, and it stabilizes at 18.5% in year 4, which indicates solid cash generation for operations. Overall, with these facts, the project demonstrates a strong profitability.
So this slide provides an overview of the project's FCFF and its accumulation over 5 years, showing how cash flow and capital investment evolve over time. So starting in year 1 with 104,750, the FCFF grows each year, reaching for the perpetuity 117,958. This steady growth shows that operations are becoming more efficient and profitable, providing an increased flow of cash. Accumulated FCFF starts as negative, representing initial heavy investments. By year 3, it turns positive, reflecting a major turning point where ongoing operation cash flow begins to cover initial investments. This positive trend shows reduced reliance on capital expenditure over time, freeing up cash for profitability. So in this slide is highlighted the cash flow and net working capital needed for the project. We want to point out that the operating net working capital drops from 8,000 to 7,650 in year 2, stabilizing at 7,959 by year 4. So this clearly reflects an efficient capital management. Furthermore, we see that the inventory cycle being only 3 days ensures a rapid turnover and an efficient stock management. Lastly, the 15-day payment terms strengthen supplier partnerships, while it offers at the same opportunities for early payment discounts.
Now let's move on to the value creation and the final recommendations. So first, on the left-hand side, we will calculate the present value of the cash flows by discounting the cash flows for the first 4 periods at the 12% cost of capital, which gives us a cumulative NPV of 60,140 euros. Assuming a 0% growth rate, meaning that the future cash flows after year 4 will not grow, we calculated the terminal value using the cash flow of 117,802 in year 4, which is equal to 982,986 euros. Then the terminal value is then discounted back to period zero, resulting in a present value of 624,706 euros. Finally, the sum of the discounted terminal value, which totals to 624,706 euros, and the NPV of the first 4 periods, which is 60,140 euros, gives the total NPV of the project, which is equal to 684,845 euros. On the right-hand side, we have a couple of metrics which are key of our analysis. So first of all, the NPV indicates that the project is expected to generate this amount over the minimum required return, which is 12%, and that is worthwhile. For the IRR, it is much higher than the cost of capital, which is 12%, suggesting strong profitability. It's the same thing for the modified internal rate of return, which also shows that it's above 12%, which is very good. Finally, for the payback period, this indicates that the time required to recoup the initial investment is relatively fast and that the project is on a tendency of a lower risk. Moving on, it is very important to assess the potential risks that could impact the success of a project, and that's why we are divided into the industry risks and the operational risks. On one hand, on the left, we have the industry risks, which are external factors or threats that arise from the broader environment like seasonal demand, economic downturns, and customer preferences. On the other hand, we have operational risks, which are internal factors that affect the day-to-day operations and may impact the project's ability to run smoothly, like, for example, staff turnover, safety norms, and supply chain disruption. Recognizing these risks is essential for creating mitigation strategies and adapting to market changes.
To conclude with, the final recommendation would be to invest in one of Europe's busiest and most dynamic tourist hubs, like it can be Barcelona, that help to minimize the risk, benefiting from the location advantage. The project is expected to generate strong cash flows, ensuring flexibility in day-to-day operations and enabling reinvestment, expansion, or adjustments as needed. After everything said, all the rest is in your hands. Invest in us and in this amazing project. We are looking forward to the possibility of working together to make this project all a success.